Index funds and ETFs get talked about like they are the same thing, but they are not, and the difference actually matters for your wallet. In the next few minutes, I'll break down the real differences in cost, taxes, and convenience so you can figure out which one actually fits how you invest. Let's start with the basics. An index fund is typically a mutual fund designed to track a market index, meaning it holds a broad basket of investments and aims to match the performance of that index rather than beat it. An ETF, or exchange-traded fund, can also track an index, but it trades on an exchange throughout the day like a stock. So the core idea, broad, low-cost, passive exposure to the market, can be identical. The difference is mostly in the structure and how you buy and sell them. Traditional index mutual funds are usually bought directly through the fund company or your brokerage, and orders are typically executed once a day after the market closes, at the fund's closing price. ETFs trade throughout the day at whatever the current market price is, just like a stock. For most long-term investors, this difference rarely matters much, but it matters more if you like to automate contributions on a set schedule. Since some brokerages make automatic recurring investing easier with mutual funds than with ETFs. Both index funds and ETFs can have very low expense ratios, especially when they track the same broad market index, so cost alone often isn't a clear winner for either side. Where costs can diverge is in trading. ETFs are bought and sold like stocks, so depending on your brokerage, you could encounter bid-ask spreads or, in rare cases, trading commissions. Many brokerages now offer commission-free trading on ETFs and no minimums for some index funds. So it's worth checking your specific platform rather than assuming either option is automatically cheaper. This is where ETFs often have a structural edge, particularly in taxable accounts. Because of how ETF shares are created and redeemed, they tend to be more tax efficient, generally distributing fewer taxable capital gains to investors than a comparable index mutual fund might. In tax-advantaged accounts like a 401(k) or IRA, this difference doesn't matter at all, since taxes on gains are deferred or eliminated, depending on the account type. So the tax question really only becomes important if you're investing through a regular taxable brokerage account. Index mutual funds have historically sometimes required a minimum initial investment, though many providers have lowered or eliminated these minimums over time. ETF, on the other hand, can typically be purchased for the price of a single share, and many brokerages now allow fractional share purchases of ETFs as well. If you're just starting out with a small amount of money, this accessibility can make ETFs feel more approachable, though this gap has narrowed significantly in recent years. If you're investing inside an employer retirement plan, you often won't have a choice. Many 401(k) plans only offer mutual funds, including index funds, rather than ETFs. Index funds can also make sense if you like setting up automatic recurring investments on a schedule and want to avoid thinking about daily price fluctuations. If tax efficiency isn't a major concern for your account type, and you value simplicity and automation, a low-cost index fund is a very reasonable default. If you're investing in a taxable brokerage account, the tax efficiency of ETFs can be a meaningful advantage over time. ETFs also make sense if you want more control over the exact price and timing of your trade, want to start with a very small dollar amount, or simply prefer the flexibility of trading throughout the day. For many self-directed investors building a portfolio outside of a retirement account, ETFs have become the more common default for these reasons. Here's the honest truth. For most everyday investors, the choice between a low-cost broad market index fund and a comparable ETF matters far less than other decisions, like how much you're saving, how consistently you're investing, and how low your overall costs are. Both can be excellent tools for long-term investing. The real mistake isn't picking one over the other. It's letting the debate distract you from just getting started and staying consistent. So that's the honest breakdown. Costs and structure can be similar, but taxes and account type are usually what tip the decision one way or the other. This video is meant to help you understand the trade-offs, not tell you exactly what to buy, so think about your own accounts and goals, or talk to a qualified professional if you want personalized guidance. If this helped clarify things, subscribe for more straightforward breakdowns of investing topics, and I'll see you in the next one.